On this episode of the Stock Market Playbook, we've got Dave, Data Guy, and he talks about how he approaches the stock market, how he's contrarian in many of his views, his book he's written about all of this, and what he thinks about data and AI stocks. It's a pretty great episode. I think you're going to love it. Give it a look, and let's see what Dave and myself discuss in this coming episode. Thanks, everybody. All right, Dave, thanks for joining us on the podcast today. Happy to have you. As we were chatting a little bit before hitting the record button, I think we've got some great stuff to cover. But before we get into all of it, tell my listeners, just give us a brief background, who you are, where you come from. Let's dive in on that.
Yeah, sure. Thanks for having me, Jared. I'm really excited to do this with you. I'm Dave, Data Guy, which I'm known as on X. I have about 30,000 followers on there. I'm also the author of this wonderful book here, Across the Street from Wall Street, where I worked for about 8 years in my 20s. You can tell where I worked, and that's explained in my book and on the back cover. I worked in a large building right across the street from Wall Street. So I'm the author of that book, and then also the author of my Substack, which is really the brains of my operation, where all my action takes place. The Substack is called Trade at Your Own Risk. It's been growing exponentially, almost around the clock. I get subscribers 24/7, and that's where I have I have over 3,000 subscribers, most of them paying. And that's where I do all my work on a weekly basis or sometimes daily. I have a chat room in there, a 24/7, 365 chat room, which you get as part of being a subscriber. So that's kind of been like a little mini Wall Street Bets. We have a lot of smart people in there, and I believe even hedge funds are in there. So maybe I think we might even be moving some stocks in there. So, but yeah, so that's really my thing. I'm the author of the book and the author of my Substack, and that's my thing.
Excellent. So you come from a bit of a Wall Street background, and then somewhere along the way you kind of branched out on your own, started a Substack, authored some books. Are you trading? Are you investing your own money as well alongside all of that?
Yeah, absolutely. I have a fairly large trading portfolio that's I put out on my Substack to my subscribers with updates, every week. So yeah, I trade. I do everything. Trade, long, short, trading, leaps, options. I do everything. So mostly though, a long-term type investor / swing trader. So
cool. So what is your so you said options and leaps, and obviously those kind of newer to the option space, kind of long-term options, right? What is your what would you how would you classify your investment thesis? Like, what's your approach to the market?
Yeah, my approach is that I sit back and look at everything. To me, I don't rule anything in or out, and I mostly look at everything, because the market is everything. So I don't limit myself to anything. I look at I listen to people on Twitter, on X. I listen to people. I listen to my hairdresser. I listen to my Uber driver. I'll listen to anybody, my bartender, anybody that has a stock tip, because you can't rule anything in or out. I mean, you might find the dumbest person that you might think is the dumbest person on X, or a friend of yours that knows nothing about stock investing, but and they get every pick wrong. But you know what? They might get one pick right every couple of years. So I want to be there for that. So I listen to anyone, and being with the high kind of profile nature I am, and kind of on social media, I get daily everybody's texting me, or look at this stock, look at that stock, and I look at just because I can look at something doesn't mean I'm going to buy it. So that's kind of my approach.
It's a great crowdsourcing kind of way. It's pretty interesting because sounds like you've been in the market for a long time. I have as well. I'm creeping up on 25 years or so in the stock market, and when I got involved, the average trader was somebody that had like some retirement money that they would buy some good stocks and never touch, right? And then, as technology got better and the early 2000s, people could be more involved in the market more easily, right? And immediately the retail traders became the dumb money, and the people that would just lose all their money and not do anything, smart. And that has shifted so much in the last, I don't know, several years, right? To the point now where we have things like these prediction markets where the average everyday person is in masses predicting pretty significant things, right? And so this dumb money has kind of shifted to smart money, and so it is interesting to listen to kind of what people are talking about and doing and so on. It's pretty interesting. I'm just looking at a chart of AEO, right? American Eagle. And I haven't been in AEO in a while, but I was, a couple years ago, and I had a heck of a run on it, and made some great profits on AEO. And I remember telling my wife, I said, guess what? I had this killer trade on American Eagle. And she goes, oh, yeah, all of our kids have loved American Eagle for like the last year. I love going there. I buy tons of stuff from there. And I'm like, well, you could have told me, because I probably would have bought it a year earlier and done way better, but like, so it's funny to see that kind of the crowdsourcing of information has actually gone from this noise to something to pay attention to, for sure.
Yeah, I'll even take that I'll extend that a little bit. And this is critically important to the way I think, and I think important for your listeners. So there's kind of a misconception by me. If you follow me on Twitter or on X, that I always mostly do the opposite of everyone in there. And that is true. I would say about 90% of the time. But it's very important that I tell your listeners this. I don't do the opposite of everyone, mostly everyone, because I think they're stupid or dumb. And there's a very simple reason why I do the opposite of everyone. And I say everyone, I mean everybody on X, everybody that you meet in daily life, everybody,
Yeah.
even your wife that was talking to you about stuff. And there's a reason that I do the opposite, and I'll tell you why. Because your wife, your hairdresser, my bartender, my Uber driver, everyone on X, they all have one quality pretty much in common. And what that quality is, they all are normal. I know you might laugh, but that's the main quality that 90% of investors have. They think they're normal, and they think normally and logically. Well, guess what? A guy like me comes in, and I look at that, and I do the opposite, because you know what? If 90% of people are normal and logical and think normally and logically, which I believe they are, the stock market is not normal. It's the opposite of that. The stock market makes no sense. I tweet this all the time. And once you understand that the stock market makes no sense, and it's not a normal and logical place, as I even said it in my book, Across the Street from Wall Street, well, then there's your answer why I do the opposite. And I'll tell you what, doing the opposite of 90% of people, I have the receipts to prove it. It pays very well. I've done really well the last several years, including this year in the stock market, really taking the opposite trade. So when a lot of people on Finex are selling, I'm buying. When they're buying, I'm selling. And I do these little memes and stuff. And a lot of people approach me now. They're basically sick. They send me DMs in Twitter. They say, you know what? I wish I would have listened to you the last 3 years, because I'd be worth millions of dollars. My subtle tweets when I say, I know, everybody's selling CleanSpark. That was my famous one back in February, and everybody hated CleanSpark at $9. And then I did a tweet, and I literally went on and I bought I just loaded up on CleanSpark when everybody hated it. And now look at your computer. What's CleanSpark at today? It's almost double that. It's almost $19, and I bought it at $9. So I have example after example after example of taking the opposite trades of Twitter and banking a lot of money. So and that I'll wrap this up. That gets back to something. There is no right way to invest. And that's another thing people don't understand. Most people, there is no, like, my way might not be. Your way is not the right way. Whatever way there is no right way to stock invest. And people need to really realize and understand that as well.
Well, I always like to, as people ask me about this kind of thing as well, the right way to invest. I think there's correct principles everybody needs to understand, right? And you got to understand risk. You know, you can't control what the market's going to do. So, you know, if there were a right way to invest, it would be understand your risk, understand your personality and your temperament, and understand your goal, right? And then you formulate your strategy around that, because you're right there. It's you could take my successful, you know, we haven't had a losing year in the hedge fund in a long time, but the way I trade, somebody else could just consistently lose money at, right? Because they, you know, have different risk tolerances and different kinds of comfort levels. So you have to kind of find what works for you, but you always got to keep in mind the things you can control: your trade size, your risk management, and all of that. But there is so many ways to skin the cat, right? No offense to cat lovers, but there is you know, there's so many ways to approach the market, and there's so many interesting, you know, I mean, I've been at the stock market for long enough that I don't even know if I'm a contrarian or if I'm the contrarian's contrarian anymore, right? You know, you kind of you lose track of who am I going against, and I don't even remember what everybody's doing now. I just, you know, I have my criteria that I look for, and maybe people are on board with that, maybe they're not, maybe everyone's buying that, maybe everyone's selling that. But what are you, I mean, there's certainly I mean, obviously, a topic that I've brought up with the past several guests is obviously the AI trade and what we see happening there. And you know, funny enough, a lot of people say it's burned out, and other people say it's only getting started. And it's such an interesting way. Um, you know, I mean, you've got to keep in mind the hype, right? That has happened. These focuses that happen in the market everywhere, right? We've seen it with, you know, with crypto and with everything in the past. Before, software was so great, hardware's terrible. Now software's meh and hardware's great, you know. And we've got this AI space. What are you loving right now? What's kind of an area that you think is underappreciated and everyone's hating, for example, that you're loving?
Uh, well, this is a good question, and the way I would answer this is I'll drill down. I'll go high level first, and then maybe drill a little. Is that you have to have a balance when investing and picking stocks because, and I'm going to answer your question here. There's a fine line you have to juggle between being in what I call the crowded trades or and balancing. You have to have a balancing act between being in all what I call the FinTwit crowded trades, like the AI, a lot of the AI, and then being in stuff to balance it out, stuff that no one else is in. Okay, so that is something that's always on the top of my mind because here's the thing: you don't you do want to be in you sometimes you want to be in the what I call the FinTwit crowded trades because they're all the ones that are going up most of the time. I mean, do you really want to be stuck in a stock that's under the radar? It might be a great company if you think it is, and then it's undervalued or cheap, as some people say, but
Sure.
it's not really that hot yet, But I like to be in a stuff that's hot, so I like AI. I mean, to me, a lot of my investments are in AI, but I also have a balance. I like, I'm in some natural gas, and those stocks are going up today, a lot. So I use now, people that subscribe to me know my whole portfolio. I did a whole episode on it. Is that it's
Yeah.
very balanced, but I am top heavy into tech. I mean, look at my name, Dave Data Guy. I, I mean, I've worked in tech my whole life, so I probably know more about tech, probably almost anyone. And I worked in software. I do data analytics. So of course I love AI. And the thing that I like about AI is that it's so early yet, and it's been transformational in my life. I did a tweet yesterday that I found a stat over the weekend that in 2000, when everybody's talking about the stock market crash of 2000, the tech crash, 5% of the people in the entire world had an internet connection. That was 5% in 2000. Fast forward to today, 75% of everyone on the planet, over 6 billion people, have an internet connection. So this, to me, is why a lot of these stocks are moving up like 100% a week, because it's just everybody is in tech. You have almost 80% of the world. So that's why a lot of these stocks are going up and they're flying, and it's still early for them. I agree with like Dan Ives said, he's a big tech person, is that we're in like the third inning or the second inning of this AI build out. So that's
It
where I'm
it
oriented. I'm oriented towards more of the AI stocks right now.
yes, and that I mean, it's interesting because specifically in the hedge fund world, right? I've talked about this in the past, but like some of these hedge funds, Ken Griffin, with Citadel, and some of these others have said, 6 months ago, they said AI's a lot of noise and it's not helping a ton. And then a month or two ago, I'm hearing and I'm seeing these interviews where they're saying, geez, like AI is significant, right? And it's almost there. Like the AI trade got running like crazy before anybody was making money on it. Obviously, Nvidia was making a ton of money selling their hardware, but now it's like we're going into this level of these companies are starting to integrate it. They're starting to um, find the actual value in what AI can do for them. I mean, we're a smaller fund. I don't have a ton of employees. We're certainly sub hundreds and hundreds of employees like some of these other hedge funds. And for these small funds like us, it is so crazy useful. I always have a couple of quants working on all kinds of different things, and all of a sudden I have this AI that I can, Claude. I've had to upgrade my subscription to $100 a month, and I'm getting the output of like 4 quants from this, right? And I'm saving myself crazy amounts of money on things that I can now easily do myself or have one person do the job of 3 or 4 or 5. I mean, it's significant. And so we're seeing these companies starting to adopt that. Obviously, there's the other side of the coin of, the ridiculous amount of money that's being invested in this, and will those financials ultimately balance themselves out? But it's changing the game for so many. And I mean, I would be kind of curious. I haven't really tried to talk to anybody about this, but I'd be curious to find out who's not using AI and what their reasons are around it. Actually, the funny thing is that I've heard, by the way, is my wife has a couple of like early 20s girls that work for her that are anti AI, and I'm finding out that like the early 20s crowd, the late teens, early 20s are kind of like AI is terrible. Don't use it. Don't whatever. They're being their typical kind of counter culture, whatever kind of selves. But I mean, of business owners and people that have need for more capacity. I would be so shocked to hear who's not using AI and what they're doing in its place, and are you able to keep up, and so on. I mean, it's an interesting shift we're seeing for sure.
Well, I can tell you the people that aren't using it, like the people you described working for your wife, that they were probably in the 1920s, they'd probably be anti-automobiles too. And
Totally.
also in the 1800s, they would probably be anti-electricity. They probably still, want to use candles. So there's
Bring
in
on the
history,
well
there was
water.
always, yeah, there's always. I can tell you an example. This is fascinating. I just use AI to find something at 5:30. I get up early. I did a search. This was something that AI found. I tested it. I didn't even think it could do this. So at 5:30 this morning, there's a stock I own called Innodata, INOD. I have a large position in the stock. It's gone up over 100% this year. INNODATA is the stock. So I got up, and besides myself, I was one of the earliest people in this stock. But the other person in the world that you would probably know is Dan Ives. You know him, the guy with the colorful shirts on CNBC. He was
Yeah, great
he
style.
was in the stock before I was. So what I did was I set up like an alert that I wanted to know, because this guy could probably move this stock, and not a lot of people know he owns it in his ETF actually. So this morning at 5:30, I set up an alert. I said, go find. I did it in I think Claude. Go find me anything Dan Ives said recently about INOD stock ticker. Well, sure enough, in about 10 seconds, it looked through all the video. Now, this is the fascinating thing about AI. It found it in 10 seconds that it went through his video. So it happens to be on Friday. He was on CNBC and doing like a 20-minute or 30-minute interview. And in that interview, he only mentioned this INOD ticker for like 20 seconds. But guess what? The AI found it. I tweeted that out this morning, and I was he lumped it in with Snowflake and some of these other great companies. And so how would I have ever found that without AI or anything? Like the magnitude of just that That one simple thing made my whole day today because, by the way, if you go and look at INOD stock, and I don't know, before I got on with you, it was up a lot today. So,
Yeah, looks like it's up
so
10% right this moment.
well, there
So
you go. So I'm making
that's a
money
great
even
day.
as we're talking. See, I'm always making money. Yeah.
I love it. That's great. So do you have like so you like to find these stocks that are getting not as much attention as they should? Where would be like an exit point for you? I mean, you don't have to give me like a dollar amount, but like what tells you that it's time to take profit on INOD, for example? How do you manage that exit?
That's a good question. That's a case by case basis. So I'm not a big. If you read my book, I'm not a big macro person. Matter of fact, I have a chapter in my book. It says I only look at macro maybe 2% of the time at most. However, in today's world, you have to look at some. You got to look at, knowing that where our leadership is in Washington and everything like that, and tweets and where the economy is. We're in a war right now. You'd be really dumb not to look at macros. So I'm looking at even though I normally don't, but I reserve the right to change and some of my way I look at everything. And to answer your question, it's a case by case basis. I look at valuations. I look at where, like, data. That's a good example. That stock I think is going to triple. It's just my opinion. It's not advice. So I know a lot more about that stock than most people, and I am nowhere near selling that stock. If anything, I'd probably buy more. So, however, I have a couple of stocks: Nokia, Clean Spark. I'm up a lot of money on these stocks, 50 to 100%. Is pretty soon I am going to sell at least half my position in these stocks. Like,
Yeah.
so I will start, after a stock is doubled, Jared, that's just in my book as well. I talk about like this doubling. That's when you got to sit back. If you made double your money to start cashing out. So that's kind of my plan. I look for a doubling. And then, so what I do is some of these stocks, so like the Nokia that I just told you, which is one of the hottest stocks now, I won't sell out. I'm not going to make the dumb mistake I made last year. I made a 700% return on SanDisk, and I was all happy. I went out to a restaurant and posted pictures that had filet mignon and lobster and everything. Well, that was great. But guess what? If I would have just I sold all my position of SanDisk after like a 7x return, but I'd be sitting on like millions of dollars if I didn't sell it today. So the thing is, you want to be very careful. So what I learned, my lesson was, and I'll give your listeners, our listeners, a lesson here, is that like a stock like Nokia, I learned my lesson with SanDisk and some of these other ones that I sold too early, is that I'll buy like options, leap options, to juice up my trade. And I also
Yeah.
load up a stock I have high conviction on, Jared, like Nokia. I loaded up, $9 or $10. I bought more shares and more options for this. To answer your question, this is for the reason I did it, because when Nokia doubles to like 20, from 10 to 20 or even to 25, I am going to start selling like half of my position. Well, you can only sell half your position if you had originally a small position and you sold, you might as well just sell the whole thing. So I scale in bigger to high conviction names in the beginning, like Nokia, and then I sell half later. So I make money, then I hold part of my Nokia shares. I might not sell for 5 or 10. I mean, I think that stock's opinion, not advice, is going up a lot more. So I kind of be
Yeah.
stupid to sell all my Nokia stock. So that's kind of how I would answer that.
Interesting. Yeah, that makes sense. Now, what about so that's how you exit. How about how do you enter? Are you looking at volume? I mean, like you said, you don't want to be stuck in these stocks that are, it's a great company, good financials, it's not going anywhere because nobody cares about it, right? And so what's the catalyst that gets you in? Would you qualify yourself or categorize yourself as like a momentum trader? Are you trying to find some trend, or do you like Clean Spark, for example, like you said, a hated stock, everybody's selling it? What was the catalyst or the reason that you said, okay, I got to buy into this even though everyone's selling it?
Yeah. Well, Clean Spark's a different example because I owned that before. So I already knew the company. And I traded it successfully. So that's another thing too. People shouldn't be shy about double dipping on. You can buy, people forget that you can buy and sell a stock and then buy it back again. I know it sounds mind blowing to some people, but so that's Clean Spark. Now, a stock I would give you an example and answer your question is Ouster, which I'm up more than double my position at OUST, which is also one of the hottest stocks out there. For that stock, I use Fibonacci. And matter of fact, I wrote a whole article on Fibonacci. This is probably one of the most great. I mean, ask all my subscribers, like thousands of them. We use it religiously. Fibonacci's been around for thousands of years, and it really works. So I use Fibonacci, I use moving averages, and I look at the technical chart. So those are the three things I'm looking at. And I look at valuation, price to sales. So I look at 4 or 5 different things of, what I would call valuation of a stock, Fibonacci, the stock chart itself, moving averages, price to sale ratio, maybe PE ratio a little bit. So I'm looking at those 5 things. And then I will throw in a 6th thing. It's called common sense. So I throw that in too. You always have to have that in stock investing or anything in life. So, a stock like OUST is robotics, and I knew LiDAR and the eyes for robots. And it didn't take a genius to figure out that this stock was, going to explode one day, which it has. And, a lot of that trade was common sense, but a lot of it was math, was Fibonacci. I mean, so I use you can't just look at yeah, you'll get lucky in the stock market. Some people will. I mean, a lot of people now are getting lucky because the whole market's moving up. It's making everyone look smart. So luck is involved a lot it's more involved in investing than you think it is, especially in bull markets. Everybody's looking like a genius now on Twitter. So
the bull market geniuses, man, they're reigning free, but it's certainly, that has a life to it. And that's where, I mean, the only investment advice I ever like to give anybody is, yes, everybody makes money in a bull market, unless you're a perma bear, and there are those out there. But managing risk, that's my favorite investment advice is you just got to manage risk, because bull markets come and go, and, losing a year's worth of profits in a bad month or two is certainly a bummer. So that's great. And Fibonacci, man, that's always an interesting topic. I used to use Fibonacci quite a bit in my early days of trading, and it was always an interesting thing to watch it play out. And it's funny. It's hard to believe these things, even though you see them over and over again, right? It's like, why does this mathematic equation work the way that it does? But you're right, Fibonacci's been out there a long time, and it seems to have an impact on the market still.
Well, it works. It's 70% effective, 70, in a bull market or a trending market. So that, I'm not going to argue against 70%. But you did mention something, risk management. I forgot I had this on my list. It's critical to mention. So you just mentioned it. The way I look at it is risk management is a couple things. One, if you were going to go from New York to Los Angeles, or in your case, I would go from New York to Denver, where you are right now, I could get there on a motorcycle. Would you take a motorcycle or a car to get there, or a Tesla? You can get there. You'll get to the destination. Maybe, I don't know, a motorcycle, you might not make it a lot. But what's more risky, driving from point A to point B, from New York to Denver? I'd rather take my Tesla or my SUV. You can take your motorcycle here, or we can drive it together, and I bet I'll beat you to the destination. And I might even, you might not even make it, alive. So on a motorcycle. So you have to look at kind of investing like that. I look at, every stock, you can find the risk of it or the volatility. Just go to Yahoo Finance. There's something called beta, BETA, and look at that. If you have a stock that has a beta of 1, it's about as risky as the S&P 500. If you have a stock that has a beta of 4, like Clean Spark, for example, COSK has a very high beta. It's probably, off the top of my head, it's probably 3.5. You get what you sign up for. Even Tesla stock is over a 2 beta. Tesla stock, ask anybody that's a Tesla shareholder. I own a Tesla. I don't own the stock. So I'm not, I don't want to take that level of risk. So every stock has it's like going to the grocery store and look at what you're buying has like a warning label on the side. Well, the warning label for stocks is the beta. The other way I look at risk is this. I'll end this answer to this risk management is I think this is very interesting. You can stay on the sidelines. I mean, risk management, it doesn't have to be any more technical than actually staying out of the market. Earlier this year, I stayed out of the market for months. That just not investing and going to cash, half your portfolio in cash. I met a guy one time. He's one of the best stock. He's made over $80 million in the stock market. He's written books. His name is Mark Minervini. He's a genius. He's probably like my mentor. So Minervini, this guy's funny. Like he's on Twitter. He's got 500,000 followers, and he's written 3 books on stock investing. But this guy cracks me up because he is very big on risk management. But he would put out tweets like, during the stock market crash of 2001 to 2003, he went golfing for 2 years. Like in Florida, he just said, like he even did it even during COVID. He said, all right, I'm going to my Florida house. He literally posted on Twitter. It's hilarious. But this guy's made over, $70 million in the stock market. You got to know when to just not even trade at all or invest. And probably it was a smart idea from 2001 to 2003 to go golfing and not put any money in the market, because the market just kept going down and down. I've lived through 07 to 09 great financial crisis. I was working in the middle of it on Wall Street. So, the devastation of that, I mean, that was brutal. Nobody today can even understand that, because people are too young now on Twitter, but to understand the 2007 and 9 great financial crisis was, horrific. So
Yeah,
that's how I look at risk management.
Good. I think that's great. Yeah, it's definitely one of the most important and probably underappreciated by newer investors. So risk management's key. But okay, so to kind of wrap up the discussion, this has been awesome, and I appreciate all your insights on everything. You're loving watching some INOD. You're loving some Nokia. Give me one more favorite stock before we wrap it up.
A little stock I'm in, ASP Isotopes. I'm already up a lot of money on this stock. They have multiple shots on goal, as I told my subscribers. So this stock is into quantum, it's into nuclear, and it's also into helium. They mine, which is very rare now because of the Iranian crisis. There's not, and helium is used in chips and stuff. So this company is on the forefront of even bringing online by the end of this year more helium, and so that's a stock I have options on. I'm going to make a lot of money. I've already made a lot of money in this stock. I bought it like $5. I don't know what's that today, but everything's up on that stock. That stock could go to $10, $12. So there's another double there. And the other thing I would wrap up is couple things. Two quick things. You don't need to be early on a stock. This is something on Twitter. You'll see people post like every day. They try to, well, I was early on this stock, I was early on that, but you don't. I would really. This is something very important for your listeners and viewers. Is that you don't need to be early on a stock. Like I'm not the kind of guy that's going to get into that guy in the Rocket Lab at $2 or any stock really for that matter. I'm not that smart, and I don't. And I can even argue that getting into stocks very early is even more risky because it could go down. Sure. It might never go up. There's a lot of high risk. So, I look at a stock like Flex, my second highest position, FLEX, which has gone up, 120% this year, which I've made on that stock. But here's the thing. I bought Flex at $60 only a few months ago. I bought more than double my money. So you could argue that I got into Flex late. I got into 60. Well, people might say, well, why did Dave, you're so smart, why didn't you get into 30 or 40? Well, I don't know, but nobody else was in it either. But here's the thing. I got in it late. People would say, quote unquote, you got into Flex late at $60. Well, guess what? The stock is like 150 now. And do I really care that I got in late and I more than doubled my money? So that's one thing. And the final thing I would tell people is this, just the best advice I would give. Your network is your net worth. I'm going to repeat this. Your network is your net worth. And really, that's where it's gotten me to where I am now in stock investing and just, this whole writing the book and things is that it's so true. You might want to sit and learn, stick your head in a book and in your accounting books and technical analysis and try to find this and that and try to figure out the next great stock. But you might not even need to do that much research. I mean, once you get to a level, maybe where I'm at, I have, high profile. I got people texting me. You'd be surprised the high profile people that text me on my cell phone, and this stock and that stock. And I'm friends with people on Wall Street. You know, I met Jim Cramer, et cetera, et cetera. So I don't necessarily need to. I kind of make a joke about it on my Twitter account. You know, some stocks I only put 30 seconds of research, like LUST. I looked at the chart and I looked at Fibonacci. So I kind of make a joke about it, but it's really not a joke. I mean, if you get to a level, even where you are, I'm sure you get pinged by people. Even your wife now seems to be giving you stock tips. So I mean, you can get them. You not need to do a lot of research. So that's kind of where I look at. Start investing in relationships. You know, forget about maybe investing in courses and spending thousands of dollars, because you can spend thousands on books and stock investing courses. I don't offer courses. I just offer my Substack, which is very affordable, but you don't necessarily need that because it might not even work. You might spend $2,000 on a stock course. I know people that charge $5,000 for stock courses, but is there any guarantee that if you take those, you're going to actually make money in the market? Not necessarily. So I've gotten most of my stock, probably 80% of my giant winners. I've been in a lot of them last 5 years. Celsius and SanDisk and BE. I was buying BE at $7. Bloom Energy. All these stocks, but a lot of them some people told me about them, but so that's kind of where I would leave it, is to try to build up your network.
That's great advice. Well, I appreciate you spending some time with us today. You've had some great points, and we definitely appreciate you being here. And we'll make sure to include your X profile and your Substack with this episode, and it'll so people can kind of keep an eye on what you're doing and follow you more, and hopefully you'll keep having some of these great calls. These are some great stocks. So that's very good stuff.
I appreciate for having me. I'm gonna tell all my my subscribers on X, and I got 30,000 of them, about your website and all the great things you're doing. So, and a lot of educational things on your website. So I'm gonna make sure I tell everybody about those and go on it myself. Jared's got a lot of videos on there, and I haven't even watched them myself. Looks like a weekend's worth of video watching. So I might have to lock myself in a room by myself this weekend and watch all your videos.
That's right. Lots of popcorn is all I have to say. Lots of popcorn.
And Celsius. I got to bring Celsius.
And Celsius. Excellent. Well, thanks, Dave. Thanks for being on, and we'll keep track of everything and hopefully have you on again in the future.
I appreciate it. I'd love to be on again. Thank you.
All right. Thank you.